Hi guys, in this video we will talk about the main macro indicators that will help you understand the US economy and how it can affect your daily life. Okay, let's start with US GDP, which is the highest in the world. GDP as defined by the Bureau of Economic Analysis website, which is the official website in the US, is a comprehensive measure of US economic activity. GDP measures the value of the final goods and services produced in the United States without double counting the intermediate goods and services used to produce them. So, for example, if you are making a bread, you will only add the value of bread, not the value of flour, oil, yeast, labor, etc., in addition to the price of bread, because cost of all of those are already included when you come up with the price of bread you want to sell. So, including them again will be double counting. Okay, so as you can see here, changes in GDP are the most popular indicator of the nation's overall economic health. The latest US GDP growth rate for the first quarter of 2024 is 1.6%, according to the advanced estimate of the BEA. This is as of April 25, 2024. And as you can see in this chart, it is showing an increase since 1947. There have been a couple of times when the GDP had fallen. One of them was the most recent 2022 COVID pandemic time, but mostly it has increased. And if you compare it with other countries, we will see the top 5 economies of the world by GDP, and here US is way above the rest. But as you can see, China is slowly catching up. The historical average GDP growth rate for the United States from 1947 to 2024 is 3.19%. In some years, it grew more, in some it grew a little, and in some it even declined. The next measure is GDP per capita, which shows what is the average income per person in the US. We calculate it by dividing the total GDP by the total US population. This is an average measure, and of course, there is a great disparity between the rich and poor. Next one is inflation. Inflation refers to the general increase in the prices of goods and services over time. It impacts our purchasing power and savings, which makes it crucial to monitor it. Inflation is still very high, even though a lot of measures have been taken to control it. Right now, it is projected at 2.6%. The Fed in the US is trying to control it by tightening monetary policy through raising interest rates, which I will talk about soon. As you can see that prices have risen across the board, especially for housing and services. Inflation in the last 2 years has been pretty high, but now it is slowly coming down. If the inflation stays elevated, it is a big threat to the economy because your money loses its purchasing power. So make sure to protect your investment against inflation by investing smartly. One way to protect your finances is through smart investment strategies that hedge against inflation. Investing your money in a diversified assets instead of keeping it in a bank account helps preserve your purchasing power. The next one is interest rate. Interest rates influence borrowing cost for mortgages, loans, and credit cards. Why you should care about it? Because changes in the interest rate can affect your ability to buy a home or finance any large purchases. Lower interest rates make it easier to buy a home and are generally favorable for the stocks. In the meantime, capitalize on high interest rates by keeping spare cash in your high yield savings account. I use Ally Bank and I have a separate video explaining different types of high yield saving options, so you can check it out here. As of now, the federal funds rate is around 5.25 to 5.5%. This is the key interest rate that affects all the other interest rates in the economy, like for auto loan, mortgage, student loan, and anything else for business investments also. Markets were anticipating interest rate cuts in 2024, but the recent inflation data suggests that it is still not the time, and Fed is likely to maintain its current interest rate for some more time until the inflation eases. The next thing that I want to talk about is the US stock market, and here we are going to look at the S&P 500, which is the 500 largest US companies by market cap, and it kind of indicates the overall sentiment about the US stocks. Another one is the Nasdaq Composite Index. So overall, they tell you the economic health, and it affects investment returns and retirement savings. US stock market hit an all-time high in the past quarter when S&P 500 reached 5,000 mark first time. However, current forecast by Vanguard has suggested that emerging market stocks can outperform US stocks by about 2.5%. So, as you consider which stocks and funds to hold, you can also look beyond S&P 500 and look at some international and emerging market index funds. For example, VEMAX, which stands for Vanguard Emerging Market Stock Index, and this comprises of emerging market companies from India, China, Taiwan, and few others, or Vanguard Total World Stock Index Fund, which has many other companies. So brokerage wise, I feel Vanguard has the lowest expense ratio. I would not put too much money in the international stock index, so make sure to keep it under 10% of your total portfolio because it tends to be highly volatile. The next is the housing market, and it influences property values, mortgage rates, and rental prices. Understanding trends help you when you are making decision about buying a house for your own use or for investment purposes. Over the last 1 year or so, high mortgage rates and low housing supply have reduced affordability, particularly for the first time buyers. Mortgage are currently 38% more expensive than renting, and by 2030 owning a home is projected to be 11% pricier than renting. So, understand housing market trends to make informed decisions about renting versus buying. While renting may currently be more financially sensible, owning a home remains one of the top goals for many people. The next indicator is the employment figure, which includes the unemployment rate and the job creation data. It is important to know these numbers because it reflects the current job market conditions and income opportunities. Unemployment rate compares the percent of the labor force that is without jobs but are actively looking for work. As of May 3rd, 2024, the unemployment rate is 3.9%, which means 4 people are unemployed out of 100 people in the US. And its long term average has been 5.7%. So it shows that the economy is still very robust. If we compare it against some other leading countries, then you can see that China has about 4.9%, Japan 2.6%, Germany 3%, India 7.3%, the UK 3.6%, France 7.4%, and the Russian Federation 4.7%. If we compare it with other countries, US unemployment rate is still very low, and it is usually collected once a month, and the numbers get seasonally adjusted. If you look at the graph here, during the last 5 years, it had spiked in April 2020, and this was due to the COVID pandemic, and lockdown had occurred, so many small businesses had to close. Also, during the financial crisis that started in 2008, unemployment rate gradually rose to 10% in 2010. The Fed in the US doesn't have a target unemployment rate, but it aims for maximum employment as part of the dual mandate alongside with the price stability. Now, let's look at the cryptocurrency like Bitcoin. It has gained a lot of traction as an alternative investment, but it remains very volatile. So, but despite the volatility, the market of it is thriving. Bitcoin in particular saw significant growth with the approval of Bitcoin ETFs in January 2024. Also, the development of L2 blockchain infrastructure could further increase Bitcoin's demand. I personally stay away from investing in crypto because I don't understand it well, and it has a very high volatility. So even if you want to, I would recommend you invest a small portion of your money in it, which you can afford to lose. The next one is gold. Gold is considered a safe haven asset during economic uncertainty, and it usually has a hedge against inflation or market volatility. Despite gold's long standing reputation, US stocks and bonds have historically surpassed gold's price appreciation, which many people don't know. But in specific shorter durations, gold also showed superior performance, especially during times of elevated inflation and geopolitical instability. So during those times, gold generally performs well. But over the long run, if you look at, then stock market and real estate has outperformed gold. And if we just to give you a perspective, during the Russia-Ukraine war, the gold prices spiked to above $2,000 per ounce, and the same happened during the COVID pandemic lockdown when it touched 2075 per ounce. So after watching this video, I hope you learned enough to understand the basics of our economy and can become financially smart to make informed decisions. By keeping an eye on inflation, interest rates, stock market, gold, and housing trend, you can gauge economic conditions, plan for your future, and make sound financial choices. Thank you for staying till the end, and I will see you in my next video. Please don't forget to hit the like button and subscribe to my channel if you enjoyed today's video. Take care. Bye.